How much do you really know about your income tax? Is it just an annual headache, or do you understand the rules that govern it? Let's pause for a moment and think about it. Isn't it intriguing how a piece of legislation, the Income Tax Act of 1961, has such a significant impact on our lives? Today, we're going to delve into this act, unravel its important sections, and simplify the complex language. Stick around, and you might just find your next conversation starter. The Income Tax Act, 1961, is the cornerstone of income tax laws in India. Born in the early 60s, this comprehensive piece of legislation provides the legal framework for taxation of income in the country. It is the tool that empowers the Indian government to levy tax on the income of individuals, companies, firms, associations of persons, local authorities, and any other artificial judicial person. The Act does not just stop at defining who is taxable. It goes on to categorize income under 5 different heads: salaries, income from house property, profits and gains of business or profession, capital gains, and income from other sources. It also outlines the tax rates, exemptions, deductions, rebates, and relief that can be availed by taxpayers. In essence, the Income Tax Act, 1961, is a critical instrument that ensures the government has the necessary funds for public expenditure. Now that you have a general understanding of the Act, let's dive into its sections. Section 1 of the Act is all about the title and extent. This is the very cornerstone of the Income Tax Act of 1961, setting the stage for the entire legislation. It's like the cover of a book, giving us an idea of what the pages within hold. Now, let's delve a bit deeper. Section 1 is divided into 2 parts. The first part mentions the title, the Income Tax Act, 1961. The title, quite simply, tells us what the Act is about. Income tax. It's an act that governs how income tax is handled in India. The second part of Section 1 talks about the extent of the Act. It states that the Act extends to the whole of India. This means that the rules and regulations laid out in this Act apply to all of India, without exception. So in essence, this section establishes the Act's authority over all income tax matters in India. Scene script. Section 2 is where we get our definitions. Diving into the heart of the Income Tax Act, 1961, Section 2 is a treasury of definitions that are pivotal to our understanding of the Act. Here, we get to know specific terms that have been used throughout the Act and comprehend their unique legal implications. Let's start with the term person. In the context of the Act, a person is not merely an individual. It encompasses a wide range of entities, such as a Hindu undivided family, a company, a firm, an association of persons, a body of individuals, a local authority, and every artificial juridical person. This broader definition allows for a comprehensive tax system that includes every possible income-earning entity. Now let's take income. Income in the Act is not just your salary or profits from a business. It also includes gains from property, both movable and immovable, and profits from any source whatsoever. This wide-ranging definition ensures that every form of income, no matter how small or large, is accounted for. Next up, assessment year and previous year. The assessment year is the financial year in which income is charged to tax. The previous year, on the other hand, is the financial year immediately preceding the assessment year. For example, if the assessment year is 2024 to 2025, the previous year will be 2023 to 2024. Understanding these terms is crucial for determining when your income is taxable. And there you have it. A handful of definitions from Section 2, but each one teeming with significance. They are not just words, but keys that unlock the complexities of the Act. So remember, whenever you come across a term in the Act that leaves you scratching your head, chances are you'll find its meaning nestled in Section 2. These definitions are the building blocks for understanding the rest of the Act. Now let's talk about incomes that are not part of your total income. Section 10 of the Income Tax Act, 1961, is a fascinating part of the legislation. You might be asking yourself, why would we ever want to talk about income that doesn't count towards our total income? Well, the simple answer is, it can save you money. This section lists certain incomes that are not included in the total income for the purpose of taxation. That's right. These are incomes that you don't have to pay tax on. So, understanding this section can help you make the most of your money. One such example is agricultural income. If you're an individual who generates income through agriculture, it's not included in your total income for tax purposes. This exemption is provided to support the agricultural sector, a crucial part of our economy. So, if you're sowing seeds, reaping crops, or tending to your farm animals, rest assured the income you generate from these activities won't be taxed. Another example is income from life insurance. If you've received any amount under a life insurance policy, including the bonus, it's exempt from tax. This is the government's way of promoting life insurance among individuals. It's a safety net, not just for you, but for your dependents as well. But remember, while these incomes are not included in the total income for tax purposes, they must still be disclosed in your income tax return. It's about transparency and adhering to the rules while also benefiting from them. In conclusion, Section 10 is a little treasure trove of tax exemptions. It's a friendly reminder that not all income is taxable, and understanding this can help you plan your finances better. So take the time to familiarize yourself with these exemptions, and you might just find you can keep a little more of your hard-earned money in your pocket. Knowing what is not taxed can be as important as knowing what is. Section 80C is all about deductions from your gross total income. Now you might be wondering, what does this actually mean? Well, it's quite simple. Section 80C of the Income Tax Act 1961 provides a list of expenses and investments that you can deduct from your gross total income before arriving at your taxable income. Let's delve into a few key deductions, shall we? One of the most common deductions under this section is the life insurance premium. Yes, you heard it right. The premium that you pay for insuring your life can be deducted from your gross total income. This deduction is available for policies taken not just in your name, but also in the name of your spouse or children. Next up, we have the tuition fees. If you're a parent, you know education doesn't come cheap these days. But here's a silver lining. The tuition fees paid for the education of your children can also be claimed as a deduction under this section. Remember, this is applicable for a maximum of 2 children. But that's not all. Section 80C also encompasses deductions for contributions made to Provident Fund, investments in tax-saving fixed deposits, and even the principal repayments of your home loan. The list is quite extensive, isn't it? Now, you must be thinking, that's great, but is there a limit? Well, there is. The maximum amount that can be claimed as a deduction under this section is 1.5 lakh rupees in a financial year. Any investment or expense beyond this limit will not fetch you any additional tax benefit. So you see, Section 80C is not just a boring piece of legislation. It's a tool that can help you reduce your taxable income and consequently your tax liability. It's like the government's way of saying, hey, we understand you have certain essential expenses and investments. So go ahead and deduct them from your income before you calculate your taxes. Understanding these deductions can help you plan your taxes better. So the next time you think about your taxes, remember Section 80C and the deductions it offers. After all, a penny saved is a penny earned, right? We've covered a lot of ground today, haven't we? From the very title and extent of the Income Tax Act 1961 to its definitions, we've delved deep into the intricacies of this comprehensive piece of legislation. We've explored Section 10, which lists the incomes not included in total income, providing you with insights into potential tax-saving avenues. We also took a closer look at Section 80C, which presents a multitude of deductions from gross total income. These deductions, if properly understood and utilized, can significantly reduce your tax liability. It's clear that the Income Tax Act 1961 is not just a document, but a tool that can be used to plan and manage your finances effectively. The importance of understanding this act cannot be overstated. It's not just for finance professionals, but for every individual earning an income. It impacts how much you take home at the end of the day and how much you can save for your future. It's about making smart decisions today that will benefit you tomorrow. In conclusion, the Income Tax Act 1961 is a complex but crucial piece of legislation. It's a roadmap that guides us on the path of financial responsibility and savvy income management. The key to navigating this path lies in understanding and applying the sections of the Act that we've discussed today. Remember, knowledge is power, especially when it comes to income tax. Until next time, Stay informed and stay savvy.